So here we are picking up with the direct write-off method. So I want to show you guys before we start writing things off and deeming it worthless, I wanted to start from a little bit from the beginning to show you what was probably the original journal entry that we wrote down whenever we recorded this sale. Okay, so it says assume that we made a $4,200 sale or receivable to DL Ross. So likely what this journal entry would have looked like was a debit to accounts receivable on said date, whatever that date was, of $4,200, and then my credit was probably sales of the $4,200, right? And so now we're in this predicament where we've tried to locate the customer, we've called them, we've emailed them, we've done everything, and we just can't we can't seem to collect the money, right? So now this is where this part comes in, and now we're going to write it off. Now, if you're anything like me, a visual learner, this is what this looks like. So accounts receivable, remember that's an asset, so debit, credit. So we originally recorded here $4,200, right? And so now we're going to write it off, meaning we're going to say, hey, we're not going to get this money. I'm going to do the opposite of what's in that account, okay? So right now, the opposite would be a credit of $4,200 to represent that, hey, I'm not going to get this money, right? But we know the rules of debits and credits, and our debits must equal our credits. So the journal entry to capture this $4,200 credit or to write this off would be a debit to bad debt expense. Come on. Of $4,200, and my credit would be to, again, my accounts receivable, right? That account is going down because, again, I no longer am going to receive this money. So, hey, no point in leaving it on the books if I know I'm not going to get it. All right, so moving on. As mentioned before, I know that I'm not going to receive this money from my particular customer. It's just, hey, it's part of the game. I got played, I guess you would say, right? So now we're going to, now what happens if the customer comes back and say, hey, I'm sorry I ignored you for a couple of months. Here I am. Let me pay you back, right? So let me show you what it looks like, okay? So I'm running out of space, so I am going to erase some of this. Sorry. Okay. So in essence, what you need to do is now you need to reverse that you wrote this off, right? You cannot leave this on your books as a write-off, right? Because now you're getting the money. So in order to show that you're recovering the money, you need to back out that you wrote off that bad debt expense, right? So when we originally wrote it off, it was a debit, a debit to bad debt and a credit to accounts, bad debt expense, and a credit to accounts receivable. Now I'm receiving the money and now I need to do the opposite, right? So all of these same accounts in the same exact amount, and I'm going to do the opposite of this. So I'm going to do a debit of accounts receivable of $4,200 and a credit of bad debt expense of $4,200. What I have effectively done is erase this journal entry, right? Because we know that in accounting, you can't go back and start erasing things, right? That is against the rules of the generally accepted accounting rules, right? Principles. So now I want to show that, hey, the customer's finally paying me. What's my luck? Great, right? So now I'm going to have to receive this cash, right? So I'm going to do a debit of cash in the amount of $4,200, and my credit is going to be to accounts receivable for $4,200. Okay. So that is, I know my handwriting looks a little bad. So here, again, if you're clicking through the slides, this is what it would look like. Okay, so I'm going to erase this so it can clear up. And so this is what it would look like. All right, so we went from the very beginning to now getting paid. Okay. All right, so what I'm going to do now is we are doing example number 1. Okay, so as example number 1, it says that on January 19th, we sold merchandise on account to Dr. Kyle Narby for $6,400, and the cost of goods sold was $3,000. So it's telling us to do the journal entry to write using a write-off method. Sorry, I kind of skipped that part. All right, so let's see what this looks like. Okay, let me change the color to be blue so you can see. Okay. All right, so on January 19th, this is what my journal entry looks like. So here we have 119. So if I sold on account, my debit is going to be accounts receivable of the $6,400, and then my credit will be sales of $6,400. Okay. Now, we also need to record the cost of goods sold. So don't forget chapter number 5, right? So our debit is going to be cost of goods sold of $3,000, and then my credit is going to be to inventory. Okay. All right. So hopefully you're feeling good about this particular part. So now on June 2nd, 6/2. We received $500 from Dr. Kyle and wrote off the remainder off to uncollectible. So we tried, the only thing he paid us was this amount, right? $500. So we're going to recognize the cash, right, of $500, right? And then our credit would be accounts receivable because that's decreasing because we're getting our money of $500. Okay. Now, we need to talk about the remaining, right? What we are not going to receive. So if I did a quick math, what I should recognize is that the original receivable was for $6,400. That's what I sold him. He only paid me $500. Therefore, the money that is still owed to me is $5,900. Okay. All right, so now I'm going to write this off. So to write this off, it's going to still be under 6/2, which is June 2nd. I'm going to do a debit to bad debt expense of the $5,900, and my credit will be accounts receivable $5,900. Okay. Now, if you're in Cengage doing this problem, I can almost guarantee you will not have 4 lines to do this journal entry. And the reason is because we have some like terms in here. So we have accounts receivable as a credit here and accounts receivable as a credit. So we can combine this. So this is what the combined version of this journal entry would look like. Okay. And what is going to be expected in Cengage? You're going to do a debit. You're going to do a debit of cash. Right, we're combining these 2 entries together. So we're going to do a debit of cash of $500, right? A debit to bad debt expense of $5,900, and then our credit will be to accounts receivable of the $6,400. Okay, we just combined. Here was a credit and here was a credit. So let's just combine them. Okay. All right, so now we're on October 23rd, so 10/23. Okay, so we reinstated the account. So Dr. Narby came back and he was like, oh, my bad, here's the money I owe you. So this is what the journal entry looks like to reinstate this account. So first off, we need to back out that we originally wrote off this journal entry. And to do so, we need to do a debit to accounts receivable in only the amount that we wrote off, which was the $5,900. And then our credit will be to bad debt expense of the $5,900, right? So we have to completely erase that we wrote it off. And now we're going to actually receive the amount in full, which is going to be a debit to cash in the amount of $5,900, and then a credit to accounts receivable. Okay. All right, so with that, I'm going to stop. If you have any questions on the direct write-off method, we will let me know or write me a comment or anything like that, okay?